Well, good morning. How you doing?
Good morning. How are you?
Doing great. All right. For those who are listening, I got Andy Farmer in the house. He is my financial consultant and does everything finance with him. Now, I will give the caveat right at the beginning of this podcast that we cannot give any financial advice over the air, nothing of that nature. But what we're going to do is kind of have an open dialogue here of all the different things you can do with retirement and all that. So I wanted you back on here because you're a good speaker and everybody loves listening to you. But more importantly, you and me have had so many conversations over the past year. I mean, shoot, you and me talk almost daily. Mm-hmm. And it always goes back to money and finances and how can we do this and how can we move that. And you and me always laugh because there's no school. There's no school where you go and say, okay, this is a 401k. This is what the stock market is. What's a dividend? What's all these? But you and me always bounce ideas off each other all the time. Hey, if I do this, what are the tax implications of this? What's the finances of this? And you and me are always just, batting ideas around. Some of them are crap. Some of them are great. And we're always going back and forth on that. And so I wanted to kind of share some of the dialogue we have. Now, I know with your profession, we can't, give advice over the air here, but it's just kind of a vocabulary lesson of just some things. For me, I've always thought my entire life, up until I met you 2 years ago, that I go to work, I get a paycheck, all the heavy lifting is done on my end. I've gotten a job, I made somebody proud, if they gave me a paycheck for my time, and now I have this money in my hands, and now from here on out, the money I spend, that's for my fun, my freedom, my pleasure, whatever. I buy a house, I buy a beer, whatever. That's my choices. And now that I've met you and talked about that, that's not the finish line. Once you get a paycheck, that's not the finish line at all. In fact, now that you have that money, you can't work forever. Your body physically won't label it. I mean, that's why we have retirement homes. You retire, you settle down. Your body physically can't go till the day you die. Mm-hmm. And so you have to think about that future and you have to kind of build past that. So with that, I'm now realizing that once I'm done, for me as a business owner, once that company's done and I've scraped off the bonuses and the end profits and whatnot, I'm not done yet. I'm not even close to done. Now I need to have that money make money for me. And a lot of people, I don't think, recognize the fact that there are more ways to make money than just replacing your time for $1. You replace your time for $1, that's fine. You're getting paid for your time. But if you have enough stockpile of money, that money can make money for you. And that's called investing. And I don't think anybody really takes advantage of it. I mean, what do you guys see on your end?
Well, I'd say, joining the Man of War Society, I would say the things that I do, stocks, bonds, Roth IRAs, 401ks, mm-hmm. They're completely overlooked. But that's like tier 1 foundation level wealth building. Mm-hmm. And of course, there is real estate that you can buy. And then you can buy a business. All of those get more and more difficult to sell because they're less liquid. Mm-hmm. Where stocks and bonds, those are going to do just fine. Do you remember when I told you that fella that had the 401k and he said, I'll cash that out so I can buy real estate so I can have tax advantages?
Yeah.
That's the part that blows my mind because what you just did is you took something that's 100% tax-free until you take it out, and then you put it into something that has tax advantages. So you put money in a 401k, put $5,000 in there, you get to deduct that off your taxes immediately.
Now, is that dollar for dollar?
Mm-hmm.
So instead of paying Uncle Sam the $5,000, you're literally taking that $5,000, putting it into a Roth IRA?
No, 401k.
Thank you, sorry.
Mm-hmm.
401k. Puts it into a 401k, and so now that money is growing for you, instead of giving that money to Uncle Sam in taxes.
Right. So when these people are talking about, I'm not going to get any tax advantages, it's not going to, they just don't understand it. Mm-hmm. So we had a guy cash out his 401k to buy a piece of real estate for the tax advantages, which makes no sense. If you have $100,000 just cooking in your 401k, it's going to keep growing. You're never going to pay taxes on it until you take it out to live off of it.
Okay.
Roth IRA is also cool.
So what's a Roth IRA? Give me the vocabulary lesson here.
So you got traditional IRA and the 401k.
Okay.
So the traditional IRA is the little brother of the 401k. Mm-hmm. And sometimes you got a Roth K, and you'll have a Roth IRA. So that's the individual version. This is the company version.
Okay.
So when you put money over here, you get a tax deduction immediately. It's going to grow tax deferred. When you take it out, it's 100% taxable.
Okay, got it.
Over here, you get no tax benefit for putting money in. It's going to grow tax deferred, just like this one. But when you take money out, it's 100% tax-free forever. And both of those, you have to do at 59.5.
So let me recap real quick here. For a 401k, basically the government's saying, hey, you're going to put this in and we're not going to tax it. Let it grow pre-tax, and we're going to tax you at the end. The other side of the equation is we've already taxed the money, so we're going to let you have post-tax money, but we're not going to tax it again later.
Yep, not even the growth.
Not even the growth of it.
Correct.
Okay. And so, yin yang. Well, you can take arguments both ways on which way's better. You have a bigger stacked pile of money that's going to grow faster, but at the same time, you got to pay taxes on it. I mean, you guys, have you ever done the analysis like what's better, pre-tax
But
or
it's
post?
really a guess.
Okay.
Because what you're really guessing is, am I going to be in a higher tax bracket when I retire or while I'm working? So it really depends on the individual. So if you got somebody that's under, like married filing joint, under that 94,000, you're only paying 12%, probably makes more sense to do a Roth IRA. But if you're in the 37% tax bracket, there could be some advantages. Of course, if you're in the 37% tax bracket now, but you also want to be later, then the Roth IRA is just powerful. But if you're making $300,000, but your retirement goal income is 94, well, that Roth IRA is going to make a lot of sense.
Gotcha. Okay.
So what I like to do is income diversification. Everybody talks about diversification, but you can also diversify your income streams. So you got make-believe guy that wants to make $120,000 a year. They're married. So we can structure their income where their income goes all the way up to $94,000, taxable. And then that's what we use the Roth IRA for the rest. Because currently you go from 12 to 22% at 94 something, married filing joint.
Yep.
So once you get over that number, you just structure the income where it all comes. Then you never get out of the 12% bracket because you're taking this from the Roth IRA.
So for people that are listening right now, what we just did is we just jumped conversations. Pay very close attention. We're talking about growing the money in something, but at the same time, we have to be aware of the tax implications. Where's Uncle Sam going to get their hand in the pocket and where they're going to take it from? And win. And that's, I think, a lot of financial advisors, from what I've seen, and forgive, I don't want to throw a big wide net here, but I don't think they think of the tax implications nearly as much as just growing the money. I really, with little people, I said, again, my circle's super tiny about the financial people. They're just like, let's grow this, let's grow that, add money here, it'll grow, it'll be great. And that's all they ever say. Never once did I ever hear somebody say, that's taxable. Yeah, you're going to get 10% on your money, but it's going to get taxed at 4%. So you really make it 6%. I've never heard anybody talk like that until I met you.
Right.
And I went, okay, I'm going to listen to him because he gets the big picture. I hate it when somebody brings us a little sliver of something to me and says, oh, this is great. And then 5 minutes later, like, well, here's the pitfalls. Like, oh, yeah, that's part of it.
Yeah, like that TikTok video that we watched. Yeah, so there's a big piece of advice that I will give on air. Don't go to TikTok for your financial advice.
Good God. Amen to that.
For any advice, probably.
Any social media, across the board. Do not listen.
Yeah, I'd say 80% really of any profession, though. 80% of doctors, 80% of financial advisors, tax people, estate, legal people.
Yeah.
They're focused on their one little thing, and they just want to get that done and go home. Whereas for me, it's more about every individual's got a different plan. But I would say most financial advisors, you hit it on the head, they collect money, they manage it, and then it's your job to figure out all the other stuff. But if it's your job, you're going to mess it up.
Oh, 100%.
Because you can practice fishing, you can practice dancing, you can't practice retirement. You get one shot. And when's the last time you ever did something great the first time?
Yeah, no, you got to practice. I mean, hell, you guys want to have a real laugh, go back to my first podcast and listen to it. It's freaking painful. I don't recommend it unless you want to laugh a lot. But you got to practice at it. And another thing that I did know, like, perfect example, you just said, first time doing it. I will tell you right now, I took $35,000, I put it in the stock market, and I became a day trader. It took me a year and a half to piss through all my money, but lost it all. And it looked, my little record sheet was horrible. I'd come in and I was worth $18,000. Do a couple trades, now I'm worth $44,000. I leave it there for a day, it all falls back down, now I'm back to $18,000. I get a hint on a penny stock. I buy like 500,000 shares and the damn thing doubled. Now I'm at $78,000 clean money. I'm rolling around super happy. Next day I wake up, it's worth $50,000. I'm like, God damn it. And I yo-yoed like crazy. So I tell this to you and you're like, that is the worst damn stock advice I've ever heard in my entire life. He goes, and you go to me and you go, you know what I do? And I go, no. And he goes, I look at it once a month. Every 30 days I look at it. That's it. And he goes, and I make my decisions once every 30 days. He goes, I don't touch that day shit. No.
Right.
And I started laughing. I'm like, well, I'd be $35,000 richer if I'd listened to your ass before.
Yeah, you'd at least have it. So many people, P.S., day trading is my pet peeve. Because here's what you're really doing. Here's what I try to teach people. Nobody, I've been doing this 22 years. I've never met someone who can accurately predict the future. Not on a stock, not on a football game. And if you meet a financial advisor that starts saying, in 6 months, this will happen, then to me, that's like going to someone in, Baton Rouge and, there's reading cards.
Tarot
They're just
cards,
making
totally.
guesses, So once you can come to the conclusion that you cannot predict what is going to happen next, then you can start making much better decisions. I've never seen a long-term successful day trader. I'm not saying they don't exist, but if they do exist, it's probably because they hit a trade like they bought Tesla, and then they just like, okay, I'm done. Like quit while they're ahead. But continuing to day trade, something wrong is going to happen, something that you can't foresee, something that hasn't happened yet.
Yeah.
So you just spread that money out.
Oh no, I got so burned on stocks that somebody says stocks, I have a little shiver go up my spine. I'm like, oh God, I hate that freaking shit.
Well, and back to taxes. So if I'm trading things less than 1 year, what have I just done?
Huge tax implication.
Yeah, you're going to trade short-term capital gains.
Yep.
Instead of long-term.
Yeah.
Which means you're going to pay it at your regular income bracket. If you're making $30,000 a year, fine.
Yeah.
But if you're making what you make, you're just stacking up taxes.
Yep. No,
minus your losses.
Minus my losses. Well, in this particular case, the losses outgrow the wins. Yeah. So the stock, Uncle Sam just looked at that guy, laughed a little bit, and moved on with my life. I really screwed that up. But that just goes to show you, I have multiple businesses. I do very well. On anybody's scale, I'm a successful entrepreneur. You would put me in the stock market, failed miserably. And that just goes to show you, just because you're good at one thing doesn't mean you're good at everything.
Right.
Yeah, you know how to grow money in a business, grow a business so it produces more. Yeah, great. It has nothing to do with financial, investing and letting it grow. And I think that was my biggest oopsies, or my arrogance saying, hey, I know what I'm doing here. I can build businesses. I can grow money. Yeah,
I would say a lot of people fall in the same thing. I'm smart, which you are.
Yep.
But it doesn't mean you're clairvoyant.
No.
But I bet if you went out and looked at the internet, there's more about predictions than there is about just good financial advice. Diversification, rebalancing, not trying to make predictions, because that's good financial advice, but you never see it. You know why? Because it's not cool.
Yeah.
Building wealth shouldn't be cool. It should just be right.
I really think you just hit the nail on the head on that. It's not cool, so no one wants to talk about it. And it's scary. I mean, right now, Roth, traditional, 401k, what's here, what's going on? So I'm going to dumb this down for a little bit. In a 401k, you put money into a 401k, and then you pick a couple plans. What does that look like? Can you walk us through a very basic 401k?
So the 401k, so we talked about the taxes. But once you get it in there, now we got all these little buckets that we can pick from.
Okay.
But honestly, there's only two. There's only two things you can invest in my world. So you got business, real estate, and then passive investments.
Okay.
And there's only two. You can own something with it, or you can loan your money out to somebody. So the ownership side is going to be what a lot of people call stocks, equities. Just like you own your house. These go up and down in value on a day. They look like walking up a set of stairs with a yo-yo, but they're also the ones that over time will outperform. And in your 401k, you have time. So that's where, for most people, depending on your risk tolerance, the majority of your money should go. The other side is the loanership side. So you're simply loaning your money out to somebody like with a CD or a bond, government bond, tax-free bond, which obviously you wouldn't put in a 401k. But these are much more stable. They do go up and down, but they're a lot more conservative historically than this side. Now, the ones that if you don't know and you don't want to think about it, there's going to be probably one in there that has a year on the end of it.
Okay.
So you get the T. Rowe Price 2020 fund, whatever's in your 401k, because you don't get a lot of choices. So you get a 2020, anything like 2025, that's going to be very conservative. It's going to be weighted towards the bonds versus stock. If you go out and get the 2050 fund, that's going to be much more aggressive. So if you don't want to think about it too much, just go out and get the longest one or the one closest. They're always a little more conservative than I like to be. Because if you're in a diversified portfolio, that's how you get your protection. The biggest mistake people make is 1 out of every 4 years, historically, the market goes down about 20%, called a bear market.
Okay.
it's not good enough to say, okay, I'm going to get out this year because next year is going to be a bear market. About on average every 4 years, the market goes down 20%. The worst thing you can do at that time is I'm going to get conservative. I'm going to get conservative, ride this thing out. When it goes back up, then I'm going to get back in. That's the worst mistake you can make in your 401k. That's akin to you saying, oh no, real estate just went down. So what's your house worth?
Millions.
All right, so say it's $2 million.
Okay.
It goes down to 1.5 million. You say, I'm going to sell it. I'm going to sit out until that house goes back up in price, and then I'm going to buy it. Once it goes back up to 2, I'll buy it again. So you're selling at 1.5 and you just get back in at 2. People do that with the stock market every day.
Including me. I totally did that. I'm like, oh, it's going down. I get out. But how do I know it's going back up? It's already going back up. Then I hop back in. Yeah, the train's already left the station, so to speak. I'm screwed. So I just lost a lot of money. I did that so much. I can't even tell you how many times I did that. I'm like, oh, it's going out. I'll get out, fall out, and I'll buy cheap. No, I sold cheap and I bought expensive every single time.
Right. But most people do. It's really what drives the market down. The market going down is simply more people selling stuff than buying stuff. That's all it is. The only thing that drives the market down. Only thing that moves it. And then the TV's job is to come out and tell you why they think more people are selling than buying.
Which creates fear. So the cycle spins even more and more and more. And then finally it kind of levels out.
Yeah, so this is not a new thing. And it will go down again that much again. And everybody's going to tell you that it's going to be the worst time till you need to buy beans, bullets, and Band-Aids. End of the world. I've been doing this 22 years. I've been through the end of the world several times. So, and there's people that will jump out. That's a lot of people. The second thing you can do is just put your head in the sand, which is not a bad strategy. It's a pretty good strategy if you're in the right stuff. Like if you're in a 20/50 fund, it's instantly diversified and professionally managed. You can just put your head in the sand. You'll be fine. Or when the market goes down 20%, I'm like a kid in a candy store or a woman in a shoe shop.
Buy.
Yep, I love it. It's my favorite time of the year because everything that I sell is on sale. But I'm the only person on my block that can put a 20% off sale and stuff and nobody wants to buy it. The jewelry shop did that. They're going to have a lot of people in there. Well, if I put the U.S. economy 20% off, nobody wants to buy it because it's never going to recover. It's done that 26 times since like the Great Depression. You know how many times it's recovered?
26 times.
26. And I don't know if it's going to do that for number 27, but I do like the odds.
Yeah.
You know, and just think about what you're owning because people are like, stocks, I can't see it. Well, you can go to the grocery store, buy a roll of toilet paper. You know, a company made that. When you turn on the news to see your bad news, what do? You're using electricity and you're paying a cable company. But there's no news that's going to come out that if you have a diversified portfolio, if you have thousands of companies all over the planet in your portfolio, it doesn't matter what comes on the news, you're still going to do certain things, right? So if
I'm still going to eat.
Russia invades Ukraine and you don't like the president because you think he's too aggressive or too dumb, or if Martha Stewart goes to jail, it doesn't matter what comes on the news. You're still going to go out to eat. You're going to put gas in your F-150. You're going to buy an F-150. That's Ford. You're going to pay ExxonMobil to put gas in it. You're going to go out and to Chili's and pay Brinker. Then you're going to go, and it's not like you're going to grab your clothes, take it to the creek, and wash it.
Yep.
No, you're going to throw in your GE washing machine, buy some Tide Pods, and you're going to keep paying companies the whole time you're worried about it not coming back. So one thing I tell when the market does go down, because people need a story. Market goes down, I'll call people, and we'll be on the phone and be like, I don't think it's going to come back. I'm like, okay, before we do that, I want you to go to Walmart. First of all, I want you to get that Princess parking spot, the one right next to the door. If you can get that, great. But you won't, because the entire parking lot will be full and you will not get the spot closest to the door. That's a good sign. Then I want you to just walk in the front. I want you to close your eyes and listen. Call me back. Tell me what you hear. Do you know what you hear if you go in the front of a Walmart? You just hear those dings, ding, 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 because people are just buying stuff.
Commerce just running.
Yep, just commerce is doing fine. The economy's bad. Just go close your eyes in the front of a Walmart next time the market goes down. And every one of those companies are making money, including Walmart.
That's a great way to say it. It's a perfect way to say it. So for me, I don't really pay attention to the stock market going down and going up because it's going to level out. I never want to say we're too big to fail, but we're pretty darn big. Like it's going to happen. At this point in time, you know, if you and I are running and one of us gets a bad knee, we're not going to die. You know, we're going to heal, move on. We're still going to run the next day, you know, a week later. So we're in for the long haul. Put your head in the sand is honestly what I'm starting to adopt to. Now, the good news is I have you on my corner now. So when I give you money, I just say, Andy, do what's best. And I walk away. And I will, and this is a piece of advice that I just talked to you. So when you and I first started talking, I said, hey, how many people try and tell you how to do your job? What'd you say to that? How many people try and tell you how to do your job? Like, I want this stock. I want that stock. Invest it here, please.
For me personally,
Yeah.
come up to me and ask and say, this is also, like I have 5. Out of the 400, I have like 5 people that will pick their own stock.
Okay.
What did I tell you before?
Oh, quite a bit more, which is good. I'm glad to hear that's less than 10%.
Well, a lot of people do that, but I don't take those people as clients.
Gotcha.
Because guess whose fault that's going to be
Yeah.
when it doesn't turn out. If they do good, they're smart. If it goes down, I should have told them not to do that. So I don't think a lot
It's
of
a
those
lose-lose.
clients- Yeah.
It's just a lose-lose.
Yep.
But for me, one of the things I said, hey, if I were to just say, Andy, here's my pile of money. I'll come back to you in 5 years. You're like, oh, you'll be happy.
Yeah.
Yeah. And that's why I'm not about, if, one of my companies is a sign company. If you were to come and tell me how to build that sign, not owning a sign company, that sign's going to look like shit. It's just going to look bad.
Right.
If you were to go, hey, here's my logo, do the best you can, it's going to look awesome because I know what to do and what not to do. So I'm not about to tell you how to do your job. I know it's my money. I know it's super scary. That's what we all work for, is the money. But at the end of the day, that's literally your job to do that.
Right.
And if anybody takes anything away from this podcast, if you have a financial advisor, actually, I'm going to stop right there. If you don't have a financial advisor, you need to get one. Now, your threshold for your business, now you've done very well. You've done very, very well in your business. So your minimum for your clients.
Right now it's 450.
Yeah, around $500,000.
Mm-hmm.
So they got to have $500,000 or more to invest with you.
Right.
And I will say this for the people that are listening. When the show notes, you can get a hold of Andy. We'll give you contact information if your value of investment's over $500,000. And that's the limit that his particular branch does. That's just because he's so freaking good that he gets to put this title in there. But for this, get a financial advisor is number one. And get a financial advisor that understands tax implications on top of what you and I just talked about. Because, yes, growing money is part of the equation, 100%. But start soon. Get a financial advisor soon. Start soon. When you make your money from the paycheck, that is, good Lord, man, that's not the end. And I'm saying that out loud as I should be talking in a mirror because I always thought that was the end. I go, I can buy a rental property, or I can do this, or I can do this with my money. But I'm done. It's now mine to play with, and it's really stupid on my part.
Yeah, rental property is great. That's an asset. Not one that I specialize in, but still an asset.
Yep.
So that's really the key. Buy things that will put money in your pocket.
Yeah.
Assets, real estate, stocks, mutual funds, 401ks. All those things will put money back in your pocket.
So you're telling me Ferraris don't put money back in your pocket?
Not unless you're professionally racing it.
That's what we call a liability.
Yeah, but a lot of people will try to do that. They'll just say, I always have to have a car payment, or my home is an asset. It's not. It's not an asset because it's not putting money back in your pocket. Very rare occasions, if you add up all your expenses and the marble countertops that your wife wanted, it's really not an asset.
Yep.
You're probably break even.
Yeah. No, I got a bit of advice in my early 20s, which I did not listen to, and it says, go into debt for your house, go into debt for your car, and then once you can, never go into debt for your car again. The only thing you should go into debt for is your house. Everything else you should be able to pay cash for and grow assets and not liabilities. Now, I wanted to grow faster in life, so I lived on the negative side of the balance sheet. You and I laugh over time because for the most part, you're very conservative. You have your buckets, you have your assets. Everything could shut down and you would be fine for years and years and years. Mm-hmm. I live with debt. That's how I run. If somebody's going to give me credit, I'm going to go take that and buy an asset and then slowly give the money back.
Yeah, as a financial advisor, I'm very comfortable with people borrowing money for assets.
Yes.
Smartly.
Yes.
And, of course, for their home.
Mm-hmm.
But that's not what most people are buying with debt and credit card balances.
No, they're buying motorcycles and trailers and surfboards and crazy vacations and shoes and
Kate Spade handbags.
Yeah.
That's like that.
No, totally. But wanted to have you on the podcast. Wanted to just enlighten just a little bit I mean, shit, you and me could be here for days talking
Yeah,
about
that's what I
this.
was thinking. Those 13 bunny trails we could have went down.
Oh yeah, I'm trying to keep that as simple as possible because there's just so much. And even then, on top of that, your diversified portfolio, yeah, you can have that. And then, I never talked to you about this. This is going to hit you blindsided here. What's your take on buying gold or buying silver? Without giving advice, just I see people do that all the time. My buddy goes, "Oh, I just bought another, 10 pieces of silver and paid $2,000 for his little coins and it's pure silver." And he goes, "I got silver now."
Yeah, so I personally don't like it. However, if we're going to follow the rules of diversification, if you're going to just do a little of something, I don't like it because it's just a fear-based investment. If you buy a lump of gold today and a year from now, people are more scared than they are today, historically that will go up. If they're less scared, that will go down. So it's just based on fear later because gold doesn't do anything. It's a rock.
Yeah.
So it doesn't do anything. It doesn't pay out a dividend. It doesn't merge with other companies. It doesn't offer any value. You're in an airplane, and there's 2 islands. You're going to live there for the rest of your life. One is covered with gold, right? But nothing else. The other is covered with people that run businesses. They have apartment complexes. But there's no gold on the entire island. Which one do you land on?
Yeah, one of the people.
Right. You're not just going to sit on a pile of gold or even a pile of money.
Yeah.
It's the economy that you want to buy. So people that trade, if they want to get in that commodity, they're usually smartly. Like if you're buying it because you think the end of the world is coming, you're going to chuck gold pieces at people. Good luck. But if you're buying it as a hedge against market drops, that's a more intelligent way of doing it. And I'll usually just put it in a commodity fund.
Gotcha.
More diversification. You can not only own gold, you'll own silver, you'll own oil, you'll own any commodity. And that tends to outperform market drops more than just precious metals.
Okay. That makes more sense to me now because I watch people do it and I've never done it. I own 0 gold, own 0 silver. That's just not my world. And I didn't understand it. So I said, well, if I don't understand, I'm not going to enter it. I educate myself.
Yeah, you can do almost anything with a little bit. So people are like, should I buy Bitcoin? Like if you're asking me, I'm worth 200,000 in my account. I want to put 200,000 in Bitcoin. Well, we're done working together. But if you want to take $5,000 out and go trade Bitcoin, it's fine. It might work.
Yeah.
Almost everything's okay with a little bit of your money.
Yeah.
Like 2008, nobody thought gold was going to do well. And gold was fantastic. It was a fantastic hedge against that market drop. I think gold, Walmart, and cash were the only things you could buy in 2008. You would have lost money.
2008, let me see what I was doing. Oh, yeah, I was trying to make sure my sign company didn't close its doors. I was working my butt off doing that. Never stared at the market other than just do a little prayer and go, please come back. That's what 2008 was for me. How the hell can I cut my costs and keep the doors open so the people don't go home with an empty belly? That was my whole goal. Never thought about big picture longevity and whatnot. And once I met you and started talking with you more, I look back on that and go, damn, I could have just spent an hour of my day, an hour out of all the hours I had during that year and said, okay, big picture, how can I be smarter with the money that I do have? And I did, not once. Just put it in the savings account and did it.
Probably the best investment opportunity you'll ever have.
Yeah.
2008. Yeah. The market was down like 54%, lasted 18 months. But it's not like people don't have the information. It's just not exciting. Like Warren Buffett wrote an article, put it in the New York Times in 2008, in October 2008, which was not the bottom. Here's one of the wealthiest men on the planet. He didn't hit the bottom. Bottom was March next year.
Okay.
He bought in October. And then he wrote an article because everybody's like, I wish I knew what the rich people do. Well, you do. They write articles. They stick in the paper. Of course, the New York Times didn't put it on the front of the paper. That was all the bad news.
Yeah.
The stuff that sells. His article was on the inside. And it was the article was titled, Buy American. I Am. And that's all he did, just bought American companies. And everybody made fun of him from October to March. They're like, look, you didn't even pick the bottom of the market. He's like, I didn't try to pick the bottom of the market. I bought it at 45. I bought the largest economy the world has ever known at a 45% discount. And
you say it in that sentence, everybody's like, oh, I wish I'd done that. Everybody, when you hear it in those terms, somebody actually explains it to you.
Right.
And that's why I always say get a financial advisor because you're not going to put those pieces together. You're not trained to look at the market this way. You're not spent to do that. Your profession is your profession. Whether you own a business, whether you're an employee of a business, whether you're a manager, however you make your money, I don't care about that. But there's a big, bold world out there way past what they're knowing. I always laugh too because with the news, we talk about the news, and that's where we're getting our information from. But drama sells. I mean, think about the last time you had an instance with your friends. It sticks in your mind. It's drama. It's not solved. We got to do something. But when's the last time somebody said, oh, I petted a puppy? Like, oh, that's cool. You didn't think about that 4 minutes later. You didn't think about it 5 days later. But I guarantee you would have much rather thought about petting that puppy than the freaking drama you have bouncing around in your head.
Yep.
And the newspapers know that. And so it's just scary, scary, scary every page. Freaking scary. Because that's what sells.
Yep. Or anything to make you angry or scared or and so there's interesting statistics that I find fascinating. There's 3 different things that'll affect your portfolio's rate of return: market timing, security selection, and asset allocation. So in English, when do I get in? When do I get out? What should I buy? Security selection. Asset allocation is the most boring. That's how much do I have in stocks or ownership investments versus bonds.
Okay.
94% of your return depends on asset allocation. The other 6% comes from security selection and market timing. What do they turn on? When you see the news about the market, they only talk about these 2.
Yeah.
When's the last time they turn on the news and be like, well, you should be fine if you have a well-diversified portfolio of stocks and bonds? Never, and you'll never hear it. It's like they got bells and whistles going off when you turn on the news, and they're all talking about, when do I get in? When do I get out? What should I buy? Yeah. Where if you show me your portfolio, if you show me the asset allocation, I can tell you what your return's going to be. That's how powerful that number is. Stocks versus bonds.
Asset allocation. That's it. I'm going to stop it right there, because if you guys don't understand that and you've done enough, get a hold of Andy. If you're still growing, find some financial advisor, interview them, make sure that they got somebody that's going to help you, because at the end of the day, we don't want to get up and go to work every single day unless you're a workaholic like us.
Right.
But for the most part, you want to be able to have easy street and stop doing the rat race and sit there and relax. But you by yourself, trust me, it's going to be a lot harder. It's going to take you a lot longer. It's going to be a rough one. Andy, thank you, man. I appreciate you coming on. Take care.